I've always said I think if we get this right, venture studios will be PE for early stage.
Hello, and welcome to this Venture Studio series. We're delighted to have everybody with us. Today's topic is venture studios or private equity for early stage startups. And that's a pretty provocative title in itself. Venture studios are revolutionizing the landscape, providing many new strategic advantages to building startups that are very similar to what private equity offers. So today, in this fast-paced, no-hold-barred session, we'll have Mark S. McNally, a chief in Nobody and Nobody Studios, and also Matt Burris, a partner at the Venture Studio Associates, who are going to challenge some of the conventional wisdom really around startup and venture capital. We'll talk about topics such as why is this a new breed of private equity, operational expertise meeting efficiency with capital, and then really why investors are starting to think that there's a new edge in this emerging asset class that seems to only grow greater and faster by the week. And Matt's going to probably have tons of stats to surprise us in that space. So without further ado, let me welcome Mark and Matt to the live stream. Chokes, how are you doing?
Hey, Barry.
Great. Thanks for having me. This is going to be fun.
Yeah, and this is sort of one of the great things I think about the venture studio community. There's lots of people out here all learning together. It's a rapidly emerging asset class. And, Matt, you've been doing some amazing work in the research side, finding out, collecting what works, what doesn't, and sharing that back to the community, which is always great. And then Mark, obviously, is a multi-time entrepreneur, many exits, built many companies and been involved in a number of studios. It's always great to have that great sort of juxtaposed conversation. So where we're going to kick off today, because this is going to be fast and furious session, and there's so much we want to cover, and many people, I'm sure, online are going to drop questions. Please do as we go along. The venture studio model being considered a new breed of private equity. So how venture studios provide early stage startup with the same resources, strategic guidance, traditionally thought of for larger companies in private equity portfolios. Give us a comparison, Mark, about what's similar, what's different. What's your viewpoint on venture studios being PE for early stage startups?
Yeah, well, I love the provocative, title. We were having a great conversation with Matt a few weeks ago, and this kind of came up, and we all kind of latched onto it. I look at it as this way: like PE firms traditionally are looking to acquire wholly owned, usually majority ownership, and scale something that went from like $50 million to like $5 billion. And they have this mentality of, how do I make this like a 5x return if I put the right capital, the right relationships, the right people, the right talent? How do I take this thing to the next level, right? And they're fairly successful at it. There's a tremendous amount of capital in PE firms. They actually struggle to find good acquisition targets, to be honest, right? But they were trying to solve a problem, which there's a lot of companies who are in this like $10 to $50 million revenue range that should be able to go to $5 billion. And so they have this whole thesis. If we bring our power, our capital, our network, can we take something that's really kind of cool and interesting into something really compelling, at least in their mind, right? But the economics they really are betting on a 5 to 10x, right? Which is nothing to shy away from. But the potential of taking that same mentality into an early stage, right? And there's a tremendous amount of early stage great ideas. There's a tremendous amount of early stage great companies, tremendous amount of early stage great people that are missing so much more, right? So if you can look at those things and latch onto that and take them to the next level, you're taking something from no revenue into $5 billion in revenue, and your returns are significant, right? And so that's one of the things that I think that it's interesting for us to think about venture studios being PE for this early stage model, because it's a lot of the same mentality, right? It's there's a lot more creation. Don't get me wrong. We have to be, very much involved in our vision for the market and our conviction of that market. But the same kind of power of bringing capital and bringing, this kind of extended network of talent and resources to the table is something that resonates with me. I've always said I think if we get this right, venture studios will be PE for early stage.
Yeah, and the pattern is emerging and happening a lot. I think it's something I certainly find when I'm chatting to people And, I can already see online, we've got over 100 people here dialed in on LinkedIn, more on other channels. This is a topic that fascinates people. Now, Matt, you're talking to like numerous venture studios. It's a sort of broad array of different types of studios. They're all subtly different focus. Sometimes they're verticals, sometimes there's different domains that they might to look at. What have you seen as other studios that you're spending time with when they start to think of themselves almost like as a PE firm for early stage businesses?
One of the advantages I've had in this space is I've talked to so many studios. I've seen so many different versions of applying the power and the benefit of the studio model just in very different ways. And a common challenge they have is when they go to raise money, their anchor point are generally still venture. And the studio model is so different from a venture capital model where they're just an investor. They provide a little advice, a little access, some networking support, but they're not really involved. And a studio is much more like a co-founder in the level of involvement they have. But when you make that connection to venture, it becomes an anchor point that's really difficult to move from. So one of the things I've started doing this year is like, hey, let's break this. What you guys really look like is an operations heavy private equity firm that starts and builds companies. And when you start using that framework, you're like, oh, yeah, I do have a big team. I do take a role in guiding and shaping this company. I do focus on de-risking, which is a massive focus for private equity. What can I do to lower the risk of growing this company, or at least not running it into the ground, right? I want to at least get my money back if I can't do anything else. That's a very different approach than venture capital, right? Where, hey, we're shooting for the moon. Like if we can't go there, we're going to drive it to the ground because our whole business model is building unicorns. The studio kind of combines both these. I want to de-risk as much as possible. Still want unicorns. So it kind of changes how you approach that whole paradigm when you start looking at it through this lens. And it allows you to start playing the game differently. So just an hour ago, I talked to a couple of folks who are looking to start a studio, and they're very much approaching it like a private equity fund. They're actually looking at acquiring companies at that Series A stage that don't look like they can raise a Series B. And they want to come in, act like a private equity firm in many ways. Like, let's turn this company around. Let's make it successful. Let's line it up for maybe it is a private equity exit. Maybe it is an M&A exit. Maybe if we do a great job, we move it to an IPO. But it's a very different approach. And also, I think one of the things that you can do when you start looking at the studio model through a private equity lens is a major component of private equity is financial engineering. When you as a studio look at just venture capital as follow-on, you've eliminated so many other financial approaches and tools that you could really use. And so when you break that VC only mold, you can start approaching the game fundamentally different. And that can further de-risk everything you're trying to do. So there's so many things you can do with a studio. One of the biggest challenges is how are you actually going to approach execution?
Yeah. One thing I'd love to latch on there was like the difference between the psychology of the investor, right?
Mm-hmm.
Our psychology is we feel like we're founders, right? If this doesn't work, we failed. And no offense to my brethren who are VCs, but you actually don't want too much ownership as a VC. You want to be able to say, oh, we bet on the wrong guys. Those guys failed us. You're trying to keep arm's length distance from accountability, right?
Yeah,
and they all admit it, right? They really cannot say we failed. We have to say they failed, right? And we were different. We walk right into this mic and we say, if this doesn't work, we failed.
Absolutely.
Very different mentality, right?
Yeah. Every studio has to play three roles in the companies they're building. You're part entrepreneur, you're part operator, you're part investor. And those roles come in conflict often, right? If you're the entrepreneur, you're passionate about this. You're bought in. The investor side, the studio also has to play, though. You have to be a little bit more objective. Mm-hmm. So that does become somewhat of a challenge. How do you maintain that objectivity?
Yeah.
What we see in a lot of studios is, you're using more of a stage gate, looks very corporate approach to building companies, where as you go through your process, you're evaluating, should we continue to do this? It brings a lot of that investor discipline in.
Yep.
But because it's a defined process, you know what you're trying to shoot for, and you know if you're on the path or not. And it's that nice reality check, right? Because we all have cognitive biases.
Yep.
And one of the things we all run into as founders, I've been a founder, you guys have been, I'm sure a ton of people in the audience are too. We fall in love with what we're looking at building, and we can't see clearly anymore. So having somebody with that, objective lens to look at this and go, it's not going to work for this reason, this reason, this reason.
Yeah.
That doesn't necessarily mean you kill it. Now hey, we got to fix this or we have to stop.
Yeah.
But you need that reality check. And it's really, really hard to get within a normal startup. And a lot of VCs don't necessarily want to provide that reality check either. It's tough. It's a really tough conversation to have.
Well, and VCs don't even have the power to, right? That's the important thing, right? We always say, like, as a studio, we have a majority ownership of a company for a certain period of time. And that gives us certain rights, right? And certain power. But we have to exercise them, right?
You have to.
We have to challenge ourselves. Is this working, right? So, I won't say we have this figured out. I know what our vision is, and we, work on this every single day. But what is the thesis when we started this company? 3 months later, do we validate it? Let's objectively talk about it. It's okay if we have all of our reasons, and I always have all the reasons why not. But then we can say, yes, now we're steely-eyed. We're deciding to make the next bet. We're deciding that, yes, it's not exactly what we thought, but we understand what went wrong. If you didn't have that conversation, it's way easy to go 12, 18 months down the road and burn through a crap ton of money, right?
Oh, yeah. Let's be honest. That's usually what happens in startups, right? You don't have this conversation with your co-founders. You couldn't be objective even if you did. It's really hard. Like, some people probably could, but it's not part of the regular cadence you do when you're a founder. And it would make a ton of difference if you did that. But
it's not normal. Yeah.
It's definitely not normal. It's one of those things where you're so busy building a company. All the things you should do to really de-risk this, to make sure, like, you're betting the next 7 years of your life on this. Let's make sure it's something you should commit to. All the things you should do to really evaluate that, you don't have time to do them all. So what do you cut? And you end up cutting a lot of stuff, and hopefully you don't cut the things that really make the difference in that decision. But you're really resource limited when you're building a company yourself. And that's one of the core values of that studio model. I look at the studios, ideally, it is your ideal co-founder. So think through what you want in that co-founder. I want somebody that has been down this road before.
So one of the most important parts, I think, of great, especially private equity leadership, is that ability to have good governance mechanisms in there to sit there and guide, and making tough calls and tough changes. Right, that can be anything from changing leadership members. It can be changing company strategy and approach. It feels like that happens at a high velocity, even more so in the earlier stages of a lot of companies. So what are some of the lessons learned that you've both picked up from, especially some people call it like the messy beginning at the start, or the awkward teenager years, as a lot of these early stage businesses are often trying to figure out what they want to be, as opposed to enterprises who might be looking to turn themselves around or rekindle their mojo that most people tend to think of with private equity. So what are some of the things that you think are really important about taking that analogy of private equity, but applying it to the earliest stages of company creation?
Well, I guess I'd say, my career, I've seen so many 14 and 20-year overnight successes. And I think that it's okay to talk in human terms. If you've been working your freaking rear off you've been maxing out your credit cards, you've gone through tremendous amount of stress, and you've been at it for 10 or 15 years, and your moment is coming. Sometimes you just need a rejuvenation, right? And you need people with different capital and different ideas and different networks. And doesn't mean the idea was ever wrong. In fact, it was only alive because it probably was right. But you need to give a rebirth. And that's what I always think of, like PE. PE does that all day long, right? That comes into a company that's been around for 90 years. It's got, $15 million in revenue, and they figure out how to make it 150, right? Or 1.5. I think that's even more so in the startup world. There's so many great entrepreneurs who build so many great products and have the right idea. And I just think this idea that you can come in with capital, be aggressive, bring a team, and help bring those things to life. I mean, I've been doing this for 27 years, and I come across these entrepreneurs every day. And so that's where I'd like for us to lean into as we grow and we have more resources and we have more capital, is to lean into that mentality, because I think it's just gold. It's great for the entrepreneur. It's great for us. And we can, make some really special things come to life.
So with the idea of operational expertise then meeting capital efficiency, this is sort of another part of that dynamic, right, Matt? Where you're sort of, again, living and breathing this and seeing a very broad array of studios sort of start to tackle this thing, where they're thinking, combining that hands-on support that Mark's talking about, but also being smart about capital allocation and de-risking the early stage investments. So what are some of the best practices? You've been doing some great research papers and gathering lots of great insights from the community. What are some of the things that you see sort of bubble up instantly from doing that work?
So one of the things that I see from the best studios out there, they know in the very beginning what their follow-on capital is likely to be. So they're building for, say, seed stage venture funds in their area, in their industry. So they know what the expectations are for the companies that
that's great.
be seeking that follow-on capital, and that shapes their process. But it also, best practice, pull down as early in that process as you can. Do the go no go tests. If you're building for venture, is this thing going to be a potential unicorn? If the market isn't there, why are you building this? It's not going to succeed the way you need it to. So it's an automatic bad decision. Don't do it. If you cannot find multiple potential strategic acquirers, because let's be realistic, most startups do not IPO. They're going to exit through an acquisition of some sort. Okay. Are there acquirers in this space that are interested in this? If there's only one, you're not going to maximize your value. You're taking a really big risk that they don't change their strategy. Aim for at least two. Can you validate that before you start building? Yes. If you don't have the network to do it, that becomes potentially problematic. But that is something the studio can put in place that startup founders on their own are never going to go do that legwork. They might do the first piece. Yes, we see the unicorn potential. Have you lined up potential acquirers before you started building this thing? Like, how can you de-risk this? If you're doing more on the technology side, now you're going to bring in technology experts to, yes, this will work the way we want it to. The unit economics seem like they're probably going to line up, but here's potential issues. It's how can I make really, really good decisions without a lot of information? So what are the critical ones to say yes or no to? And then how can I get some expert insight into this as soon as possible? And
yeah, I love this actually.
This one, because one of the biggest mistakes I see is let's just do customer discovery to learn everything. 3 hours in the library can save you 30 hours in the field. Do the book research as well as talking to customers.
Yeah, no, I love this as well, because the classic Tam Sam Sam slide that everyone puts in their pitch deck. I feel like it's one of these things that you have to engineer to have an addressable market over $1 billion, or your pitch deck doesn't pass the test, right? And
yes,
it's almost a creation activity. But the bit that really shines out to me is you're talking, and I hear Mark say this probably once a week, is that like 80% of acquisitions happen under $200 million. Like this is sort of the magic number, right? And really, if you're not thinking about companies that can make those acquisitions at that price, that the founding team are sort of pricing themselves out of that opportunity to have an exit if that's what they're seeking, right? Or as certainly as a studio, in Nobody Studios model, that's the only way we generate revenue, right? Our business model is simply selling companies. We don't sell services. We don't do anything else. We just build and sell companies. So that's like a key measure for us. And Mark, what are some other things that sort of jump out at you then when you're thinking, like, you've got to be capital efficient as a CEO of a studio. You've got a whole portfolio. Everyone's got great ideas. Everyone's got problems that they need to fix. Everyone's just got, if you give me a little bit of money and I run this campaign, it's going to unlock so you're just looking at like a suite of people like coming around for pocket money. So how do you make some of those decisions, to figure out like, where do you want to double down and where do you have to actually say to people no?
Look, I think I do go back to the thesis driven kind of mentality, right? So we thought we were going to do this. Did it pay out or not? Right? Let's look at the results. Let's modify the thesis and let's make another bet, right? If somebody doesn't have a thesis, that's usually a non-starter for me. And I've been using that filter for a long time, right? The last 3 or 4, 5 months for sure. If you don't think you can tell me if I do this, it's going to tell me this, or I'm going to learn X. If you just think we need to do it because, like, this is like the slippery slope of startups, right? It's really easy to get into like recurring expenses. It's really easy to get into burn rates. Really, really easy. This guy's amazing. We should pay him X. She's amazing. We should pay him that. It's really easy to get into that. I'm probably like the biggest offender. So I have to go back to, okay, great. What are we trying to accomplish? How can we structure this in a way that is like an experiment? Invest this, it should show that. If that results in what we wanted, then we're going to invest more. Like I'm teaching myself what I've known my entire life, but trying to keep myself out of my worst capabilities, which is to really love people and say, no, how do we define this the right way? It's an experiment. If we're going to do this at scale, which is what we're trying to do at Nobody, if we're going to do 100 of these at once, you don't have the capacity to be emotional. You have to say, I structured this, I decided this, we made a bet, what were the results? And then we decide from there. And that's what I'm trying to make sure we get better at it. So
yeah, no, it's great. And so with you, Matt, as well, like you're obviously helping numerous studios set themselves up, understand how to operate. Everyone's slightly a little bit different. What are some of the guidance that you're sharing with those teams about how they make some of those tough calls?
Well, there's a few aspects. I use the 4 customers framework a lot. Because as a studio, it's kind of weird. You have one product that you're selling to 4 different customers, and all of them have to say yes, or you've got some substantial issues somewhere. So you've got investors in the studio, the staff, the general partners that are running the studio, the entrepreneurs you partner with, and follow-on capital. As you define that, like get very specific about who you are supporting, that's going to start shaping your process a lot and how you have to approach building companies and operating the studio itself. So that will often highlight a lot of unique situations. So one area that studios often run into is finding the right target founders that they're going to partner with. So this can be anywhere from how do you get in front of them, build that funnel of the right folks you want to work with? How do you evaluate them? But also, what support do you as the studio need to provide to them so that they can be successful? A lot of studios, I want to work with serial founders only. Great. Like hopefully you have a network and you can tap into that and that works out for you. But most studios are going to work with folks that either haven't had a successful exit before or might not have ever been a founder before. And the support you have to provide to them is a lot different. You're still building companies, so that part doesn't change. But now there's a knowledge and experience gap that you're going to have to overcome to de-risk building companies. And so it's always a unique situation based on what the studio is trying to build, what their thesis is, what their strategy is, who they're serving, the industry and the geography that they're operating in all plays some pretty fundamental roles across all the aspects of what they're doing. So it's all over the place. It's a lot of fun, but you have to get very, very specific for every studio to really map and understand how this is going to impact what they need to go do.
Yeah, no, I love it. And like people are loving this. We've got Mohammed here saying, I have to go to a meeting, please. What are we doing? Are you recording this? And look, the good news is that this show will be available on all the social platforms for the next 24 hours at least, but you'll always be able to get it on the Nobody Studios YouTube channel, and we'll share more. And we've got a couple of minutes left, so if you have a question, I would really encourage you, please put it to Matt and Mark, and I'll make sure I grill them in the last few minutes that we have. But it's very obvious, we've over, 50 people 100 people on some of these platforms now, like live here listening to this topic. It's fascinating to folks, this analogy of private equity being applied to early stage startups. And we've talked a lot about governance, capital management, making decisions, like thinking ahead when you're building these companies. What's the sort of next link in the supply chain? Be that to future funding, acquisition, potential IPOs. There's a lot for sort of people to sort of take in. So for someone then who's probably thinking about venture studios, it's an emerging asset class. It's still a new area. They might understand PE because they've been executives in big companies and they've probably had to work with PE firms. They might understand venture capital because they're, potential limited partners and putting some of their investment funds into VCs to make investment in early stage startups. But for folks who are maybe learning new about venture studios, can you share maybe a little bit of, what you think makes them unique, and then I'll put some of the questions that are starting to come through here already. All right, here's one that comes up. How do you raise funds for a studio? Own exits, PEs, or VCs? This is a good one.
Well, I can dive into that one. Raising funds for studios is tough. The vast majority of people I talk to, I'll tell them you are not positioned to raise capital for your studio. Think of it, a good parallel is raising for a venture fund. If you look at what investors are really looking for is, do you have exits? Have you invested in companies that have delivered exits? Have you built companies that have delivered exits? Do you have markups on any investments you've made, or created a lot of value in the companies that you've started? Have you helped raise capital before? Have you grown sales substantially in the companies that you've supported? These are all things that really go to de-risking the investments you're expected to make. I would use those exact same things in a studio. If you can't risk building companies, have you shown it before? Do you have a track record? Is it aligned with your thesis? Then investors are probably going to look at you and go, you're not ready. So if you're in that position, now you've got a couple other options you can consider. One is raise money into the portfolio companies that you're building. That's how NLC Health got their start. They built 150 companies to date, probably more actually at this point, but they didn't raise for the studio to start. The other option is start by building service companies or core infrastructure of the studio. You operate that outside of the studio. So that is an entity that is focused on cash flow and profitability, but you can use that cash flow and profitability to fund the studio operations. So there's several studios that have started that way. It's been very successful, but take a hard look at you, your team, your track record and capabilities. If you can't raise money, it's okay. Consider the other paths. And if you're not ready to go down those, go work in a startup or studio or another company, gain that experience so that you can go pursue that if that's what you're looking for. Yeah,
that's a great answer. So we've got a tee up here for Mark to probably share a little bit of Nobody's unique approach. First of all, someone wants to know, hello, are you on track to get 100 startups in 5 years? And the answer is always, of course we are. That what's the Nobody slant? Like Matt gave a great examples of paths to do, but maybe you could share a bit of Nobody's flavor. And yeah, questions always fly in as we're getting on time. So we will do another one of these events again, folks. Don't worry. So, but I'll let Mark share his story there.
Yeah, well, look, I think every time you do a projection as a startup person, you have an asterisk next to it, right? Assuming the capital comes in here, this is what we're capable of, right? And that is constantly evolving. So we have 14 companies in development right now. We have 4 in the market. We do believe that we'll be fully funded this year, and we'll be in a spot where we will be probably on track for 10 to 15 companies a year. the next 18 months, right? So that's kind of our goal. That's our stretch post. But the 100 companies in 5 years was always meant to say, what kind of organization are we trying to build? Are we trying to do 1 or 2 a year? Or are we trying to do 20 a year? And if you say you're trying to do 20 a year, and if you only get to 8, you're stretching yourself towards that goal. And it makes you think differently about how you make decisions, how you greenlight things, how you kill things. And that's what we're using as a stretch for our organization. So until we can say it's going to be 1,000 in 5 years, it'll always be 100 in 5 years. But I'm very confident in 5 years we'll have 100. But it's always earmarked by, again, the capital. So we've done a lot with a little so far. We've raised more than most venture studios, but not what we wanted to. And so we're always, gauging where we can bet, where we can double down, what we think is realistic. Matt talked about this. Like, a lot of our bets are stage gated. It's like we make a small bet. We hope it results in something. If it doesn't, we know what to come back and say. We have to modify the thesis. Was it wrong? Was this business completely flawed to begin with? Was it execution? It's usually, all this messy stuff. It's not always nice and clear. But you have to go back as a team and say, okay, what do we learn from this? And I love that mechanism that is not built into a VC investment in an early stage company, right? A VC investment in an early stage company is a fire and forget. It's a really hands-off passive investment. We are held accountable. We got to look at these things and make choices. Okay, crap, that didn't work out how we wanted to. Welcome to startups. Are we going to make another bet? A lot of people would not like that. I like that. I like that part of this process. And we have to embrace it once you get better at it.
That's great. And then in closing, Matt, yourself, you continue to do great work in this space and help people understand what's working, what's not. What are you sort of most excited about and seeing in the emerging field that we're in?
I'd say the most exciting thing I'm seeing right now is more venture capital influencers talking about the studio model. This is a major step change in like broader awareness of the studio model. When I started talking about studios on LinkedIn in August of 22, there weren't many people talking about it. Last year, we had a few new faces really show up and started expanding that audience greatly. Max Pog, for example. Earlier this year, we've had a couple of major players in the VC space start to highlight the studio model in their newsletters, on LinkedIn, in podcasts. And so what I'm seeing is there's more and more awareness. It's starting to ramp up. And that's going to unlock a lot of things for the entire ecosystem. It'll still take a while, but especially getting improving understanding of the studio model, how it works, the value that it adds, unlocks follow-on capital and makes all this a lot easier. But it's still going to take time to do it. So that's the big thing I'm seeing is more understanding, more awareness of the studio model. And that's going to have a really big ripple effect.
Great. Well, look, as you can see, we've had a couple of hundred people on these different platforms here across LinkedIn, Twitter, YouTube, Facebook. It's been great to see such engagement on this. This was designed to be a little bit thought-provoking, a fresh perspective, but some insights that you both shared to get people thinking about what this sort of ever-evolving world of early-stage investment and opportunity is. Folks, we'll have we'll be doing these now every week for the next couple of weeks, inviting various different thought leaders, contributors, builders, operators, investors in the venture studio space. So make sure you follow Matt, Mark, myself, Nobody Studios, Venture Studio Associates. There's lots of great people out there. It's a great community. We're all sharing and helping one another. Thanks for joining us, and we'll see you again real soon.